Okay, hi everyone watching on YouTube or LinkedIn, and welcome to today's quick macro update. Before we get started, let me just mention that all prices and forecasts correspond to the data this publishing, and this information is strictly for training and educational purposes only. So today we're going to be covering some key news flow, Forex, and then the S&P 500. Amazon reported record quarterly revenue with earnings of 5.2 billion, blowing past analyst estimates. Apple and Facebook also did exceedingly well, fitting the narrative of tech outperformance. And then we have US Q2 GDP, which plunged 32.5%, which is the most it's ever dropped on record. And next up is initial jobless claims, which increased for the second week in a row, and payrolls are still down more than 14.5 million compared to pre-lockdown levels. So this slowdown in economic data and the fact Congress is still negotiating their next stimulus package makes the W-shaped recession probability we made our base case a long time ago more likely by the day. Next up is Forex. So the dollar had another week of weakness, with the DXY dollar index dropping 1.01%. One explanation for dollar weakness is we have been in a huge risk-on environment since the March lows, and consequently investors have fled safe haven currencies like the yen and the US dollar and flocked into risk-on currencies like the Aussie dollar and the New Zealand dollar. Also, the interest rate differential between the US dollar and other currencies has narrowed, and this was a key reason for US dollar strength previously. Another reason for US dollar outperformance in the past was that US economic growth was outperforming other regions. However, the US growth differential with other areas such as Europe has narrowed recently because the Europeans have done a much better job at containing the virus. Following on from this, the economic fallout is perceived not to be as severe the better you handle the virus, because you are less likely to need to re-roll lockdowns and therefore halt businesses. Okay, so following on with the euro, the EXY euro index climbed 1.12% last week. Various factors could be playing into this one, one of those being corona bonds the EU will be issuing. So corona bonds is this crisis debt that they're going to try to create at the EU level, and potentially if these are AAA rated, it could replace, for example, German bunds as the benchmark for Europe going forward. And people are speculating whether these developments in the euro could make it replace the dollar's world reserve status. The euro currently holds 22% of world asset reserves, and this is compared to around 60% for the US dollar. So it does hold some muscle in the reserve game. And the EU economy is about as big as the US economy. So some people are speculating the materials are there for the euro to be a competitor to the US dollar in terms of world reserve status. Right now in the EU bond market, there's a lot of different issuers, and they all have a lot of different rules. So they can't do these big, huge issuances of bonds like the Fed does. So this limits the EU from inflows of capital from, for example, huge sovereign wealth funds who want to buy into big issuances. But this corona bond idea could be a stepping stone in the right direction. However, there are a lot of limitations. A common bond from the EU has been done before, and there was no seismic change from it. And on top of this, the corona bond idea could just be a one-off. And here's a nice quote from Benjamin Franklin. The point being here is that if the EU does get their act together, and this crisis brings them together from a fiscal standpoint, resolving this age-old issue they've always had, which is how can you have a monetary union without a fiscal one, then Europe would be poised for good growth going forward. And indeed, we've seen many investors speculating this will happen with asset managers, for example, those who manage pension funds and endowments. Industry survey shows that they want to be overweight European stocks and overweight the euro. Now let's cover the S&P 500 price action alongside the dollar, as they fit together quite nicely. So here's a chart of the dollar index DXY with the S&P 500 laid over in blue. And the dotted line just shows us where we had our last macro briefing. So although, yes, I understand these narratives of interest rate differential compression and other real drivers away from the dollar that exist, I'm going to put my trading hat on now And in recent history, we can see that the DXY and the S&P 500 have had a near perfect inverse correlation. So we said last week that stocks would likely drop in the next few weeks, and that's because we're approaching this strong resistance zone here. And to find out why this is an important zone, check out the last macro briefing on our YouTube channel. But essentially, it's highly likely that this February gap, the yellow box here, once this is filled in by price, it will then become a very strong resistance zone, potentially sending stocks lower. So we have this S&P 500 approaching key resistance, and at the same time, the DXY has already recently reversed from these lows. So this is all indicating to me that we're likely approaching a risk-off period, which means stocks are heading south and safe haven assets such as the dollar and yen are heading north. So if we switch to MT4 here, when we look at the global indices, we can see that many areas such as Japan, China, UK, EU, and Australia, well, their stock indices have already started selling off. So we can see that here, whereas the US is up here. So the US could be the next indice. Their stocks could be the next to follow suit. In summary this week, watch out for the aforementioned potential drop in equity markets. On top of that, we have a stacked out agenda in terms of news flow this week. Today, US ISM PMI just came out 1 hour ago at 54.2, beating the forecast at 53.6. And this shows expansionary conditions in the manufacturing industry. Tomorrow, we have the Aussie cash rate set to stay flat at 25 basis points and New Zealand unemployment to increase to 5.5%. On Thursday, something closer to home, we have the Bank of England monetary policy report, and consensus looks to keep the interest rate the same at a minuscule 10 basis points. Finally, on Friday, we have one of the most looked at data points by all traders and investors, and that's the US non-farm payroll, which is the change in the number of employed people during the previous month, excluding the farming industry. And this is forecast at plus 1.5 million jobs added, compared to plus 4.8 million added in the prior month. And of course, any number above 1.5 million estimate will be good news for the dollar. And finally, we have the unemployment rate set to decrease to 10.5%, which would be the third consecutive monthly decrease for the United States. And anything less than 10.5% will be great news for the dollar. And that concludes the macro segment. I'd like to thank everyone watching this on YouTube and LinkedIn, and have a great day.